I was calling Fed Chief Powell Mr. Waffle House because he's been waffling for 7 or 8 years. Anybody can disagree with me. I just don't think he's been a good Fed chief. I'm not saying he's not smart. I think he's a brilliant man. First of all, we just had the last Fed meeting this week, and there was the most dissension on the Fed that we've seen since 1992. Yeah. And we've been seeing that ratchet up. Maybe you don't think this is a big deal, but I do. If you think back to Greenspan, Bernanke, Yellen, they almost always rounded the troops up and they all spoke with one voice.
Yeah.
Now you've got all of these Fed governors going out speaking all the time, and they all speak differently. These are our leaders. This is what's directing our future in terms of policy. And I think the market is just all over the place because of it. I mean, if you think back and you look at what's driven the market up or down, a lot of times it kind of correlates with what's going on with interest rates, what the market is for the likelihood of rate cuts or rate hikes or whatever. A football analogy, there are a lot of great coordinators in the NFL, and then they are appointed or, they're hired to be the head coach, and they never quite live up to all those expectations. And then they go back to being a coordinator again, and they're great. And I feel like Fed Chief Powell's a great coordinator. I don't think he's a good head coach.
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, we're going to be speaking with longtime friend of Market Misbehavior and longtime stock charts contributor, Tom Bowley. Tom's the chief market strategist at Earnings Beats. We start off strong talking about the Super Bowley stock picking competition that I participated in at Tom's invite, along with Grayson Rose of StockCharts.com. We had a lot of fun, each drafting a team of 10 players. We debrief a bit because that competition formally ends at the end of April. And so we recorded this on the last day of the competition, just reflecting on what worked, what didn't, talking about idea generation, risk management, many other topics. You will also learn why Tom calls soon-to-be former Fed Chair Jerome Powell Mr. Waffle House. I'll let Tom explain that along with a lot of other stock picking goodness here. Welcome, and thanks again for joining us on the show, Tom Bowley of Earnings Beats. Super excited to be catching up again with Tom Bowley. Tom's the chief market strategist at earningsbeats.com. Tom, great to catch up with you. How is life? You seem happy as usual, which is great to see.
Yeah, I've got a big smile on my face because after not being able to golf for about 5-6 months, I was able to take a golf trip and play 3 days in a row. So yeah, I got a little bounce in my step this week.
So it is so important. I feel like the next time we have a webcast, we will discuss and debate the value of doing things away from the markets and how that can rejuvenate and arguably make you a better investor the next day. I'm a huge fan of that. I'm planning to go hiking this afternoon after the close. So friendly reminder to everyone, take care of yourself, your mental state for sure. So listen, I appreciate ahead of time you agreeing to some ground rules to this conversation. Number one, we don't talk about Cleveland Browns football, especially after the draft. So thanks for that. That was very generous.
I didn't
the other
sign
one.
anything.
The other one, we agreed not to talk about the fantasy stock draft that you hosted back in February, because one of us on this call is currently at the bottom of the leaderboard, and the other one appears to be near the top. So thanks again for those ground rules. And I say that with a great deal of sarcasm because you did fantastically well, and I'd love to dig into some of that for sure. So start this. So what I'm referring to there at the end, you did an event called Super Bowl. You kindly invited me to participate. This was back, I think, at the beginning of February, wasn't it?
February 6th, I think. Yeah.
February 6th. And the idea was we do kind of an NFL style stock draft. We each pick, 10 stocks, and just the process of selecting names I found to be incredibly enjoyable. We'll talk about some of the individual, things that we both selected, I hope, but can you just share a little bit? Your performance has been overall pretty good. It looks like it's getting a nice boost here, at the end of the quarter or at the end of the month. How did you kind of approach that? And how would you describe your strategy trying to look forward a couple months? Like, how do you try to approach that sort of challenge?
How much time you got, Dave?
I do have other questions though, Tom. Okay, so let's keep it tight. Yeah.
Yeah. To keep it very simple, relative strength.
Yeah.
always looking. I mean, we have portfolios at earnings beats every 90 days. We swap them out for new portfolios. And so the whole idea there is we go through an earnings cycle. And after the earnings cycle, I mean, that's a lot of new information for the market to digest. And we take a look to see where money's rotating to. We don't argue with what Wall Street's doing. We tend to just stick with what Wall Street's doing. And many times it's hard to pull the trigger because a lot of the stocks that are showing relative strength obviously are stocks that have run a lot. And I think a lot of people in the market don't really want to chase, and I understand that. But at the same time, if that's where the money is going, if that's, drawing the buyers and you're not seeing a lot of selling in those areas, and especially if those leading stocks are also in areas of the market that are leading. So you get leading stocks and leading industry groups, you're constantly getting new money coming into the market, and that's where a lot of that money goes. And so it just keeps boosting a lot of those stocks that you think will never or should come down because they simply go up every day, like SanDisk and so forth. I mean, some of these companies, watch them go from 100 to 300, and you think there's no way it's got any more juice in it. Next thing you know, it's 1,000, with another triple. So I think, following the momentum and following that relative strength is probably the single primary key, I would say.
It struck me, I know when we were going through that exercise back in February, that we all kind of embraced that as a general approach. And I think that was one of the really cool takeaways of the kind of conversations we had along the way. We were all kind of thinking about relative strength, and right, the goal was to identify some of those names that have been demonstrating strength with the idea that they're probably going to continue to demonstrate strength. I know from listening to how you were approaching it, and then Grayson Rose was the third selector. You tended to pick a number of names that felt like they'd already had that run, right? They already were breaking out. And I remember thinking, wow, that feels very extended, but great real life case study of why buying things that are breaking out, you're often not too late. You're often early on in this next big leg. I guess the question would be like, what gives you the confidence to take a shot at something that already feels like it's had that move? So, I mean, our tendency, I think your natural reaction would be, I missed it. Why would I get in now? So can you talk about that part of your approach and kind of what gives you that confidence to follow on there?
Yeah, well, I guess part of it is my background being a CPA. I was in public accounting for 20 years before I got into this.
Yeah.
And so one of the things I think that's really important is the integrity of management and being able to meet the, consensus estimates or beat. I really look for companies that can beat consensus estimates because it's a very basic way of understanding that these are management teams that are executing their business plan. And so usually, the portfolios that we put together, which I pretty much took the same approach with this fantasy draft with you and Grayson. When I put together these portfolios at earnings beats, I do it based on companies that have beaten earnings and revenue expectations. So if they haven't done that, they're not, in my opinion, eligible to be put into our portfolio. So we want to have not only price momentum and relative strength, but we also want to have the fundamental momentum as well, where the business is growing, and not only growing, but growing ahead of expectations.
That's really well said, Tom. And I love how you describe that, because a number of other successful investors I've talked to and worked with have that similar idea, right? They have kind of those basic filters. And I remember it reminds me of working with, like a dividend growth portfolio manager back in the day, who said, look, I'm only investing in stocks with a dividend yield above 3%. And just that basic premise was so helpful because it eliminated a bunch of stuff that we just didn't have to worry about. And then it gave you just a subset of names. That was your universe. And then it was just all about finding the best ideas within that universe. So I think thinking of those, basic earnings requirements is like, unless you demonstrate these things, you're not even part of the conversation. That automatically filters out, bad companies, right? That aren't able to grow particularly well, I would assume, right?
Yeah. And, every once in a while it's frustrating because, I see a stock and I see the technicals and I see the breakout and it's like, man, I can't wait till the next quarter's portfolio because this is a stock I want to put in it. And then I go and do the fundamental research and I see that they came up a little short on their revenues. I'm like, oops, that one's out. So, sorry. I mean, the chart looks good. And maybe the stock continues to do well, but you're right. It's everybody, you got to have your own kind of filter. And for me, that's one of our key filters. I mean, earnings beats, that's the name of our company, so Of course, that's what we're looking for. We're looking for
Might as
companies that are
well
executing.
focus on some companies beating earnings, right? I mean,
Yeah,
if we're gonna call it that. No, that's well said. I'd love to dig into some specific ideas that came out of it. And again, I know the true goal of the competition was whoever picked the one with the best returns, and Howmet Aerospace, which was one of my names, is pretty close up there. So I don't know if I'm gonna get it, but I'm trying desperately to have some positive come out of this for me, Tom, and that's going to be one of them. But we'll come back to my fantastic selection of Howmet in a moment. I'd love for you to think about with the names that you selected, is there one that stands out as like, yeah, that is a perfect example of like the type of chart I want to be finding every time we do one of these drafts? Like, what's the one you feel really good about?
Caterpillar's been such a strong company for a long time.
Yeah.
And so I rode that strength. I mean, it wasn't, a lot of times, again, you look at a stock, you see that it's gone up so much, you say, well, could there be any more left in the tank? But what I've found over the years is that you want to stick with those leaders, those companies that are driving the market to the upside. And Caterpillar was one of those. But I would say maybe one that was even more that I really felt strongly about was VIAV, which is VIAV, which is a telecom equipment company. And telecom equipment stocks have been so strong.
Yeah.
So it's a company that was one of the leaders, had been outperforming its peers, but it's also part of a very, very strong group. And Viavi's been in our portfolios for the last 2 quarters. So when you get one stock, and the way we put our portfolios together is very similar to what we did with the draft. We have 10 stocks and we're getting them from different sectors. So we're not just trying to get 10 semiconductor companies or 10 telecom equipment. I mean, that would be easy when the market's going up. You could throw darts. The problem is with that strategy, of course, is if the group falls out of favor, you're going to absolutely get devastated. What we try to do is we try to put together these leading stocks in various areas of the market with the idea that if one or two of them really have an exceptional quarter, they literally are going to put the rest of the portfolio on their back and just carry them. And that's kind of what VIAV, before we started this recording, we were talking a little bit. And VIAV reported last night after the bell, and the stock was up this morning. It opened up 33% after its earnings report. I mean, if you have 10 stocks, that's 3.3 percentage points right there. And so you're crushing the S&P 500 when you get one company that can report like that. So I would say, sticking with some of the companies that have shown a lot of strength and continue to show relative strength, I think that's one of the keys to outperforming the S&P 500.
Common thread with both of those, right? Caterpillar, a name that most people probably know, and I'm sure you've seen the chart if you follow the markets, because it's been just one of those stronger areas in the industrial sector. VIAV, probably one maybe people are less familiar with, but the similarities are, as early February, they're both making new 52-week highs. They're both showing strong momentum. They both are showing strong relative strength. And if you're looking back, I mean, they're both sort of up and to the right. But then in the quarter since, they've continued to go up and to the right. I mean, I think for me, it's just a great kind of mini masterclass on trend following, right? And sort of recognizing the strength there. If you could do a do-over, right? And I mean, bad news, most of your stocks are up, I guess, but if you had a do-over, is there one that looking back, you're like, yeah, that did not do what I would have hoped it would? And sort of what happened with that particular name? Any come to mind?
Well, I've got the 40 stocks that were drafted, and I just put them into a 3-month time frame to see which ones have performed the worst. And the worst one I have on my group is Hershey's, which I picked for a couple of different reasons. Number one, if you recall, we had just started February, and Hershey's had a lot of price resistance around $200, and It had just broken out above $200. Number one. And number two, it was in the month of February, which happens to be Valentine's month. And if you look seasonally at Hershey's has done historically very, very well during the month of February.
Right.
And so that was kind of one of those seasonality examples where you look at it and you're like, okay, I think I can figure this one out. Something about chocolate in February. But anyway, I mean, looking back, the competition didn't end in February.
I was going to say, it had a remarkably strong February for the record.
It was very strong again.
And then March happened.
Then March happened, and I don't think it's had a bid since. So it's really weird sometimes how stocks do that. So I would say maybe that one I think
Yeah.
another one, we all put a regional bank into our portfolios.
Every one of us did, right?
Yeah, and
Yeah.
the banks, I think, we saw the 10-year Treasury yield start to move back up again. We also
Yeah.
saw, a little bit more information on what the Fed might or might not do, and a lot more of the Fed governors moving off of rate cuts and thinking they're going to be further and further down the road. The odds of rate cuts have gone down significantly for this year over the past couple of months. And as a result of all of that, regional banks, which tend to do really well when when rate cuts are part of the forecast, those, kind of took a back seat. But I don't know that that was something that we could have forecast back then. I mean, sometimes you put something into your, it's well thought out, strategy sound, it sounds great, and then you just lose money.
Right. I mean, your returns are not directly tied to how much time and effort you put in or how great the idea feels at the time. Right. And I think that's one of the challenging things about what you and I and other investors try to do is you're not rewarded directly to the amount of time and effort, right? The quality of your thesis doesn't necessarily mean the quality of your returns. So we're going to come back to Hershey's in a minute because I love to talk about risk management. But thinking of the mental side of this game, right? The sort of mental game of investing. How do you deal with that uncertainty? Because we're trying to do this thing where often you have caterpillar type of returns that just look fantastic, but then you get Hersheyed a lot of times, and the stock just does the complete opposite. And that happens. I mean, I think both of those things happen to most investors. So how do you deal with the pain and the uncertainty when just things don't go right, even though it feels so good when you put the trade on?
Yeah, that's a great question. And I think it's probably something that just about everybody struggles with.
Yeah.
Anytime you put your money up at risk in the stock market, it's exactly that, at risk. And so some people can't deal with that, and they probably need to be in CDs or in treasuries and stuff like that because they don't want that volatility. They don't want to go to bed at night wondering what's going to happen tomorrow morning in the stock market. I get that. But I think if you're in it for the long haul, I think number one, it's the process that you create, that you believe in and you're confident in over a period of time. So if you go into it thinking, what am I doing today or what's going to happen tomorrow? I think the market can kind of grab you and kind of lead you around. But I think when you have a process that you've vetted and that you feel comfortable with over an extended period of time, I think you understand that downtrends and pullbacks are part of the game. There's
Yeah.
no way getting around it. You're not going to have the best stocks every single day. And so you have to have a longer term mindset, I think, to be at ease and to be able to sleep at night.
I think that's really well said, Tim. There's a lot of, I would say, investor maturity in what you just said, right? And I would say early on for me, those losses become really emotional experiences where you feel the pain of, oh my gosh, I put money at risk and now I have less of it. But over time, right, the benefits of a repeatable process, which I think you guys demonstrate beautifully at earnings beats, is the fact that you're going to have those, those occasional names that don't work. But over time, we're going to just keep going into a process that does work. Well, so as you were talking through the example of Hershey's, my example from the exercise was Carnival Cruise Lines. One of the names I picked was CCL. And I remember vividly how that chart looked when we were doing the draft. It was just making a new high. Everything was clicking. It was like, this is the beginning of this next big leg higher. And then the world changes in so many ways. And all of a sudden, cruise lines are an absolute disaster. So one of the things that we weren't able to capture with this competition is sort of the risk management side, right? What happens when you buy a breakout and it just doesn't work? So I'm curious with a name like Carnival Cruise Lines, which rolled over very quickly, or a name like Hershey's, which was going well until it wasn't. What does that look like? What does your exit strategy look like, right? As a trend follower, what do you see on a chart that says, this is no longer, doesn't deserve a place in my portfolio anymore?
Well, I mean, what I do personally in my own trading and what we do in the portfolio is different strategies. Well, it was about 7.5 years ago. We had some members reach out because we keep what we call a strong earnings chart list, which is basically just a watch list of companies that have beaten revenues and earnings estimates. We like the charts. They're liquid. They trade over $5. We have some other filters in there, but generally it's a really solid fundamental list that most of them happen to have pretty solid technicals as well, or maybe just starting to show positive technicals. And, it's something that could develop and become a much stronger stock down the road. So we started with that, but we would have anywhere from 300 to 400 companies on this chart list at any one point in time. So members rightfully would point out and say, well, what do I do with this list? 300, 400 companies, I can't buy them all. What are your favorites?
Yeah.
And that's how our portfolios were born.
Mm.
So we said, okay, well, every 90 days, and this started, I think, November 19th of 2018. We said, okay, here are 10 different stocks, 10 different areas of the market, 10 different industry groups. We do try to, use themes to weight the sectors. So in other words, if it's a period of time where I really feel good about the market and I think growth is going to lead, I might have 5 technology stocks in the 10 stock portfolio. Well, that's 50% of your portfolio in technology when the S&P only has about 30, 32%, 33, whatever it is now. So you make these conscious bets on technology outperforming during certain periods. And then you're looking for leading stocks within leading industry groups within technology. That's the kind of the key. And so we started doing that and had a lot of really successful results. And in those portfolios, we don't use stops because we're only holding the stocks for 90 days. With the idea is that, yes, maybe a couple of the stocks are going to go against us, but it really just takes out the emotional side of seeing a stock going down and saying, oh, I'm getting out of that one, only to watch it come right back, because you set the stop too tight or maybe you were too loose, and the stock really got away from you. I mean, there's so many things that go into trading and investing, so emotional, and everything's so emotional. And so what we tried to do was to create a strategy that was kind of in the middle. It's kind of a buy and hold strategy, but you adjust every 90 days.
Yeah.
Not exactly buy and hold. You're not buying a stock at 80 and watching it go to 2. That's been the strategy of the portfolio, not really using stops. Our stops are 90 days from now, we're getting out no matter what. That's our stop. Now, in my trading, which I tend to be a shorter term trader, I don't like holding stocks 90 days. I can't do it. Like I said, we did this for members that didn't want to do what I do, which is, I'm all over the place every day. I mean, it can be. And so, I might love a stock yesterday at 3:30 and today at 9:45. It's like, I'm out of this thing. I mean, you got to kind of balance. You have to figure out what kind of trader you are or investor you are. And I think, and then kind of develop a strategy that works for you. So for me, like Hershey's, I mean, I would have been out of that. I haven't looked at the chart here, but let me see if I can pull up Hershey's. So Hershey's in February just absolutely took off.
Yeah.
We had broken above the 200 level when we did this. It had gotten up to 240 at the end of February, beginning of March. And literally, when the calendar turned to March, this stock has been doing nothing but going down. Now, there are a couple of things I would have looked at. I would have looked at the rising 20-day moving average when I have a stock that's got a lot of momentum and is trending up. I tend to use the 20-day as a key support area. So as a trader, a pullback to the 20-day is an opportunity to buy, but a close below could very well be my reason to get out, or it could be gap support, or it could be price support, or it could be a confluence of all of those things. It's hard to say, but normally when I get into a stock, I have a really good idea of what would take me out of the stock to the downside. I don't wait until I'm losing a lot of money and then say, wow, I probably should get out of this. I usually have an idea. And the whole idea with successful trading is, as you know, you want to try and time your entries so that you can minimize your risk and maximize your reward. And so that's why the 20-day moving average works as a pretty good barometer for that for me.
Tom, you made a brief comment in that well-described sort of approach to risk management that I think was very powerful, which was, to paraphrase, I don't wait for something to go wrong to figure out what my exit's going to look like. And I always use a flying analogy with people. I tell, pilots don't wait for the engine to cut out to figure out what they're going to do next, right? It's like they've got it all. It's like the engine cuts out, like they immediately go to the checklist. They know how they're going to fix it. And if it goes really bad, they'll figure out how to get the plane down safely, right? But you don't wait for the disaster to sort of plan for it. And I think that is really, really good advice, particularly for people getting started, because I find they often wait too long and wait for the stock to be down 10, 20, 30% to figure out what an exit looks like. And boy, you can save a lot of losses by not waiting so long to figure that out. So tell me this, Tom. I mean, so maybe pivot talking about the current market environment, right? The S&P is just pushing above 7,000, now 7,100, now 7,150 as we're recording this, last trading day in April. What are you seeing looking around at market conditions that either gives you confidence of further upside or skepticism of further upside? And as a follow-up, we did an exercise on our YouTube channel recently where we sort of gave 4 different scenarios, kind of the super bullish scenario where the S&P goes up to like 7,400 by the end of June, to the super bearish scenario where we're retesting the March lows and we're in a risk-off environment. And I'm wondering kind of what your vote would be from super bullish to super bearish and why.
Well, I think I'd have 2 different answers if you asked me a month ago and asked me today.
Okay.
At the beginning of the year, what we told our earnings beats members was, I thought we might have a correction. There was a lot of things that were lined up. And this was back when we were at an all-time high, close to 7,000. And it wasn't as bad as where we stood back at the beginning of 2022, but it was close. And so I didn't think we'd get a bear market, but I thought we'd have a correction. And we ended up dropping, past 10% loss on all the indices except the S&P, which I think was down like 9.8% at the low. And the day that it hit its low, because I had said my strategy was to get out the top, and then as we worked our way down toward that 10% threshold, to start building back in slowly, because I really didn't think this was going to be a market that stayed down for very long. And so I think the S&P had gotten down to around 65 or 6,600, and I started buying back in, bought like a third. And then the day that it hit the low, it had finished on the low of the day. The volatility index had closed above 30.
Yep.
And I said, I'm going to get in again tomorrow morning on the next gap down. And it gapped up and it never looked back. I never got in after that. So here I am calling the correction, getting the correction. And then I ended up not getting back in on my second third until we broke out above 7,000. And I'm still waiting to get in on the third.
Yeah.
So that's how quickly the market can change. Now, a month ago, we started to see a little bit of rotation, intraday rotation into growth stocks during March. And so that was a little bit of a clue that I thought we were getting close to the bottom. But I don't really like getting in when the volatility index is rising and at 30, because typically that's where you can have some of the biggest losses. You can wake up to a 3 or 4% drop in the market.
Yeah.
And you have a couple of those days. I mean, if you look back to April, early April 2025, we were down 10% over 2 months. And then we were down another 10% over 3 days. And so, you got to be careful. So I really had this great thought process, market selling off. We're going to have a gap down. I'm going to get in lower. This is going to be awesome. And then the market flipped the script on me, because we don't control the market. The market just does what it wants to do. And then it just took off, and it went up to the 20-day moving average. And I thought, okay, that's normal. You got a little bit of a bounce here in this downtrend. We're going to roll right back over. And instead we gapped up to the 50-day.
Yeah.
And the market just never looked back. So if you got out and you're waiting for like a new low or maybe a positive divergence or something, never really gave you that opportunity to get in. So I think the market's different today. This is kind of weird, but if you had asked me when the market was at 6,500, I would have said, no way I'm getting into the market at 6,500. But now it's at 7,150 and I'm all in, or I want to be all in, and it's 10% higher. And it's only a month later, but conditions have changed.
Yeah.
And so I don't hold on to the lows that we saw before, because since then, and especially during this rally in April, money has rotated heavily towards growth stocks.
Yeah.
Really heavily. The NASDAQ has been crushing the S&P 500. Large cap growth kind of backed off a little bit here in the last week or two, but the first 2 to 3 weeks off the bottom, growth stocks were exploding. Large cap growth versus large cap value, discretionary stocks versus staples. I mean, all those ratios that I like to follow that make me feel good about a rally, they were all lining up with the rally. And so when I start to see that, I get rid of all my bearish thoughts. So I would say at this point, I believe we're going higher.
Yeah.
I don't think it's going to be this. I don't think it's going to be like April, where we're going up 10% a month. I think, we went down, we've gotten that back, we've broken out. I think it'll be a slower, steadier kind of move. And I haven't looked lately, but volatility index, even though we were only up slightly earlier today. The VIX was really dropping, and it's been doing that now for the last few days, even though the market was trying to sell off a little bit. So I think a lot of that fear has come out of the market. And when that happens, you see bad news and you're like, okay, here we go to the bottom. And then the market rallies and you're like, what's going on? I just think the market environment's a little different than it was a month ago.
And I'm glad you brought up the volatility, right? The VIX is back below 20, kind of sitting down there. And I think that was one of the great signals in the first quarter this year was the VIX popping higher, pushing above 20. So all through February, the S&P is kind of chopping around 7,000, but the VIX is kind of steadily going up. And I remember seeing that and thinking, oh, this is not the way that a big uptrend kind of continues. And so we sort of got that snapback rally. I'm curious, and I've got a couple questions here to finish off. I mean, so you outlined the challenges of a V bottom, which is what we've now experienced, right, in March. And now they're so frequent, right? I feel like every major low has been a V bottom now. I feel like those kind of old bottoms I remember experiencing, which is like all this time and we've had a higher low, and we kind of debate whether there's bottom. It's like that's no longer the norm, right? The rule is now a sharp reversal. Is that the new normal? Is that what we should be expecting, or do you think there is something unique about the conditions here recently where those V bottoms seem to be happening way more than they don't, right?
Yeah, I've got a theory. I have a theory on everything.
I love it. Okay, hit me.
And I talk about this a lot, and some folks that follow earnings beats closely don't agree with me. And obviously people that don't follow or don't like me maybe disagree. But I think a lot of this falls on the Fed. I really do. 2017 is when Fed Chair Powell took over. We've had 4 bear markets and 2 major corrections in 9 years. And in the last, little over 7 in particular, starting with the end of 2018.
Yep.
Most of them have been very short, as you discussed. The only one really that was long was the 2022, where we went down for about 9 or 10 months. Everything else has been a month to 3 months. And then boom, soaring right back up again. And I think that the Fed has been, first of all, we just had the last Fed meeting this week, and there was the most dissension on the Fed that we've seen since 1992. Yeah. And we've been seeing that ratchet up. If you think back, and this, maybe you don't think this is a big deal, but I do. If you think back to Greenspan, Bernanke, Yellen, they almost always rounded the troops up and they all spoke with one voice.
Yeah.
Now you've got all of these Fed governors going out speaking all the time, and they all speak differently. And they, what's his name? Miram. I don't know if Myram, I might be getting the name wrong. Yeah. Stephen. He's the one that wants rate cuts. I mean, he's not coming off of that. He thinks we should be cutting rates. We just had this meeting this week, and I think the wording was that there was something in the wording talking about we don't expect any further adjustments until later this year or next year. And so some of the group didn't like that wording because it made the assumption that there were going to be rate cuts.
Yeah.
That the next move would be a rate cut. And they weren't willing to say that. So they dissented because they think that there potentially could be a rate hike, I guess. These are our leaders. This is what's directing our future in terms of, policy. And I think the market is just all over the place because of it. I mean, if you think back and you look at what's driven the market up or down, a lot of times it kind of correlates with what's going on with interest rates, what the market is for the likelihood of rate cuts or rate hikes or whatever. I mean, I was calling Fed Chief Powell Mr. Waffle House because he's been waffling for 7 or 8 years. I mean, and again, anybody can disagree with me. I just don't think he's been a good Fed chief. I'm not saying he's not smart. I think he's a brilliant man. Some people, a football analogy, I'm not talking Browns because they go through head coaches quite often.
You're towing the line though, Tom. I'm listening closely now.
I'm going to see this hook come out and take me off screen.
I can mute you at any moment, Tom, okay? Go ahead.
No, but a good analogy though is there are a lot of great coordinators in the NFL. And then they are appointed or, they're hired to be the head coach, and they never quite live up to all those expectations. And then they go back to being a coordinator again, and they're great. And I feel like Fed Chief Powell's a great coordinator. I don't think he's a good head coach. That's what I'll say about all these bear markets and corrections and everything else we've had over. I mean, the back and forth has just been crazy. And I do want to add one thing, though, because I do think that he's been dealt a difficult hand with the pandemic and the aftermath of the pandemic. There's not really a pandemic 101 handbook that I'm aware of.
There's so many great points in there, Tom. And I don't disagree with you that the Fed could be a big part of that. I think many have picked up on the dissension and sort of the open debate within the Fed, Open Market Committee in a way that we've not seen ever before. I'm curious, as we now are, preparing to onboard most likely a new Fed chair, if this ends up being sort of a descriptive feature of the Powell era, this conflict and this dissension, or whether this is just the new normal. My cynical hat would say we're seeing dissension in all parts of the life right now. So I'd love to see us go back to something else, but we'll see, right? And I've not heard Powell being called Mr. Waffle House. That's a first. So thanks for that gift, Tom. I'll credit you if I share that in my own content for sure. So the last comment would be this, and obviously we've covered a lot of ground, and I appreciate it always. It is a lot of fun. Precious metals are sort of in the back of my mind as one of those exceptionally strong trades in 2025. It's been a pretty good trade in 2026, although we are starting to see a bit of a disconnection between gold and silver and equities, right? For a while now, we've seen them very highly positively correlated. Stocks go up, gold goes up. We're seeing a bit of a disconnection with that, where in the last month, we've seen gold operate at times as more of a safe haven. Are you more optimistic or skeptical about the precious metals trade? Does that return to a position of strength? Would you position yourself that way, or more cautious for some reason here?
Well, the way I look at gold and silver, especially gold, there are two drivers, over the years in following gold. And when I talk about drivers, I'm talking about gold relative to the S&P 500. So looking at the two and deciding, okay, would I rather be in gold or would I rather be in the S&P 500? Now, being a bull, long-term secular bull market bull, I'm going to be on the S&P 500 side the overwhelming majority of the time. And I would say if there's been one thing that I've really missed over the last 18 months, it's been the rally in precious metals. I was never a believer when it started. Even after it was moving up, I kept saying, hey, you can ride the rally, but keep your stops in because I don't trust this move. And that's been my theory for the last 18 months is like, okay, I recognize the trend. Maybe if I was, followed technical analysis purely, and just looked at the numbers and saw the trend, stocks, the prices going up, I probably would have been in and enjoyed more of it, certainly than I did. But the two drivers for me are the volatility index. When the VIX spikes, if you go back and look in history, when the VIX is going up, gold outperforms the S&P 500. Mm-hmm. And when it's going up during the periods that the VIX is rising, gold tends to have massive spikes relative to the S&P 500. That's number one. Number two, gold is denominated in dollars. So you have a very, very strong negative or inverse correlation between gold and the dollar. And so recently the dollar, which I've been a very bullish on the dollar, but the dollar recently went down and was teetering on a major breakdown over a 15-year trend line since back in like 2011. And so the fact that dollar had not broken down and the fact that I still am bullish equities, I think the S&P goes up. And so therefore, normally I would expect the volatility for the most part to be down. That's kind of kept me out of that trade. It was a mistake because gold has outperformed. I mean, if you look from 2011 to 2024, gold underperformed the S&P 500 by a very, 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 very wide margin.
That's right. Yep.
So it's come back on a relative basis, but I wouldn't exactly say the chart has necessarily flipped. I think that there was a pop for a period of time, and I'm not sure that I do think gold goes higher. I just don't think it's an outperformer going forward. That's the way I would.
Yeah. Well said, Tom. As always, you're bringing a lot of clarity during confusing times, and I appreciate it. Great to chat with you. Glad you went golfing recently. Keep hitting them straight, and we'll look forward to bringing you back on the show again soon, all right?
All right. Sounds great, Dave. Always a pleasure.
It's always a lot of fun to talk markets and pretty much anything else with Tom Bowley. I met Tom years ago when I first became a Stock Charts contributor. And it's one of the great blessings of getting involved with that company was getting to know people like Tom a little better. He's become a good friend and a trusted market practitioner, and someone whose opinion I follow very closely. And I remember vividly, if you heard in our conversation, I talked about during that draft, and we did it live on a webcast, and I'm watching the charts that he's picking, and a number of those, some of which ended up being some of his top performers in the competition. I remember thinking, man, those stocks feel extended right now. And in a different world, maybe the market goes very risk off in March and April, and those stocks end up being, pretty negative. But at the end of the day, I mean, stocks well selected, and a great reminder of, really the argument for trend following, right? It's not always going to work. And we both highlighted names like Carnival Cruise Lines, and Hershey's that did not work particularly well, right? The trends just changed. But I would argue with both of those charts, as we talked about them, and as I was looking at them, the charts provided clear signs that the trend was no longer working. So I think the point of that conversation is not just about picking, 10 great stocks at the beginning. It's following those trends. And if the trends persist, as they did with VIAV or Caterpillar or Howmet Aerospace, you stick with those trends as long as possible. And when the charts tell you the trend is no longer working, like we saw in the charts of Hershey's and CCL and others, then the chart no longer deserves a spot in your portfolio. I think it's not about predicting the future. It's just about recognizing changes in trends and recognizing it early enough that it doesn't really disrupt your portfolio. But in that conversation, I hope you learned what I often learn talking to someone like Tom. Relative strength is vital. Focusing on stocks that are outperforming their peers is a tried, true, and tested approach to outperforming our benchmarks. That's how Tom approaches this game every week. That's certainly how I and many other top practitioners do as well. So I hope that's an important one. The second, really, we didn't talk about the macro environment until the very end. And so this process of stock picking, about identifying good charts, really is agnostic to broad market conditions. Now, you may ask, how can you be picking stocks if you're ignoring the macro conditions? Well, the reality is it is that you're not, right? If the macro conditions start to look negative, if investors start to go risk off and raise cash, the charts are going to reflect that. So it's not about, predicting how a macro headwind or tailwind will impact your portfolio. It's about watching your portfolio closely for signs of shifts, right? Shifts in sentiment, shifts in momentum, shifts in trend. Finally, Tom's firm is called Earnings Beats. You can learn more about the great work that they do at earningsbeats.com. Big fan of Tom's work, and I've enjoyed following his commentary, getting to know him over the years for sure. But I think he very eloquently talked about the relationship between price and earnings. That's a consistent theme that's come up on this show with a number of different guests, some that are more technically oriented like Tom, some that are more fundamentally oriented like Nick Rach, or who else have we interviewed sort of along these lines? Alex Carto from EPS Momentum, right? We talked all about earnings and how important it is to understand changing expectations for earnings. I think Tom approaches it beautifully from a technical lens, but still appreciating and thinking about the importance of earnings. And I love his comment as one final point about how he talked about limiting his universe. I'm just going to only consider, to start with, my universe is not the S&P 500 or all U.S. stocks above a 5 billion market cap. It's only stocks that demonstrate strong earnings and strong revenues. That's my universe. And then I start to find the best ideas there. You're immediately getting away from all those companies that don't have good earnings. Not a bad thought process as you're figuring out your own portfolio structure as well. Thanks again, Tom Bowley, for all the work you're doing and for joining us from Earnings Beats, sharing some thoughts with us here today on the show. I look forward to having Tom back on the show later this year. As a reminder, if you want to learn more about how to make better decisions in your portfolio, if you want to upgrade your scanning, your idea generation game, how you manage risk and recognize when those trends have shifted, our Market Misbehavior Premium memberships can be a fantastic way for you to really meaningfully upgrade your investment process in 2026. You can learn more at marketmisbehavior.com/premium. There are 3 great benefits to the premium membership. Number 1, we will teach you all about technical analysis and behavioral finance with our virtual courses. Number 2, we'll keep you informed and educated through our member-only reports like our weekly flight plan and our monthly chart review. Finally, we will give you an opportunity to ask questions. We will keep you accountable in our member community. You'll be able to ask questions at any time. I'm in there every morning, was just in there earlier today, sharing a quick video just for my premium members and answering some short questions as well. All of that and can be yours immediately if you go to marketmisbehavior.com/premium. I hope you'll take a look, and I hope you'll strongly consider joining our premium member group today. That'll do it for today. My name is Dave Keller with Market Misbehavior. Thanks for watching. And remember, it's always a good time to own good charts. Take care, folks.